We're back on the John Williams Show, 10 to 12, weekdays. Tom Gimbel filling in. And now we have Phillip Shaw, Goldstone Financial. Phillip, are you there?
I'm here, Tom. Thanks for having me.
Yeah, we were talking earlier. Do you go by Phillip or Phil? What do your friends call you? Is there a difference, or are you just always Phillip?
I introduce myself as Phillip, but I usually go by Phil. So most people who know me just call me Phil.
Perfect. So the Dow is up over 1,000. Does that mean anything? And is it just being driven by one or two companies, or what are we seeing here?
Yeah, I mean, so we're seeing what is close to all-time market highs or all-time highs for a couple of the indexes, and part of that's being pushed up by this continued, we call it the AI trade and the growth that we've seen in AI these last number of years. But reality is the Mag 7, which is what had been pushing forward the Dow, the S&P for a long time, have really been generally flat since the end of last year, and so we are starting to see this market continue to broaden out more than we had seen in the last couple of years, which is really healthy. It's a really good sign that it's more than just the big companies that are doing well. We're starting to see the overall economy, at least from the market side of things, really stable and continuing to grow.
I mean, that's where my question really originates. And I'm on the labor side. I ran a recruiting and staffing firm for 25 years. Is the markets are up, but the economy seems to be in not great shape. And it's the first time, 53, it's the first time in my lifetime that I have seen the stock market not mirror the air quotes economy. Do you think that's true, or do you think that it's better than what the media is reporting?
It's a very valid point, and actually familiar with your background. I have some folks over at your old company, but
Nice.
there really is what they're describing as this K-shaped economy going on, where we have the everyday American. If you're looking for a job openings are down, unemployment's starting to tick up. We're still feeling the effects of inflation that we saw. Not so much the ongoing inflation rate, but inflation as of a couple of years ago. It's still just a sticker shock when people are buying things at the grocery store. And it's a really big dichotomy between that and what's going on with the stock market. And some of that, frankly, may just be efficiencies in artificial intelligence. We're not seeing a meaningful tick up in the amount of people being laid off. But if companies are, to your point, if companies are becoming more efficient, if people are starting to implement artificial intelligence, they may not need as many new hires as they might have before.
Yeah, it was funny. I had an interesting conversation with an older person, and by that I'll say over 50, and which is really a different situation than I've ever seen before. Usually, young people aren't worried about when unemployment happens because it's easier to get a job and the skills are more transferable and they're not pigeonholed. And older workers are like, oh God, age discrimination. I can't get a job in my 50s. I was talking to an older worker and they said, what's interesting is my IRA and my 401k are going up. And so I'm out of work right now, but I'm not as worried about my retirement as I would have been because I'm getting that bump without the deposits. The younger person, and I've seen this with my own kids and in the recruiting and staffing industry I've seen, is that the younger kids are having a harder time finding a job and they don't have a 401k and IRA or much of one to speak of. And they're more worried about their employment status, especially with AI taking jobs, that because older people, you might need the institutional knowledge. Younger people, if we can replace it with AI, God bless, let's go do that. So it's a really interesting dynamic of stock market up, unemployment starting to tweak up a little bit, and how the people are feeling about that.
Yeah, no, I very much agree. It's interesting you say people aren't as worried about, their employment because they see their 401ks and IRAs going up. But I suppose that's probably the case. My experience is until people are, really a lot closer to that Medicare or Social Security age, if they can't find a job or if they've been laid off, it's a big source of stress for them. It's a really big problem, and kind of regardless of what the market's doing. For young people, it's a shame because if they're not finding work, they need to start participating. They need to start saving and investing. I do see higher participation rate generally in investment from younger people than we've ever seen from prior generations. However, so much of that is their 401k.
Yeah. No.
And to your point, if they're not employed, if they don't have those benefits, they're not going to see that, same kind of impact.
So we were talking about the markets. We were talking about the labor market. We're talking about the stock market. You were talking about the Magnificent Seven not being the only driver for what we have going on. So if we're looking at 25, where the market rose, 26, it looks like things are going to be a good year again this year. Two questions I'd say. A, all the talk of the new Fed chief coming in May, are we going to see Are we going to see interest rates drop, and what will that do to the market for the second half of the year?
Yeah, so as long as we have Chair Powell, I don't think we're going to see a decrease in the interest rates. So his term runs through May. We should have a new Fed chair. We'll see how quickly they can get through the approval process on that. But my expectation is we'll have 1 to 2 rate cuts in the back half of the year. I think a lot of that is labor driven. To our conversation earlier is, there is not as much hiring and there's not as much, employment as we'd like to see. And I think that's going to start being the bigger driver for the interest rate conversation for the Fed than the inflation rate is currently.
I read an interesting article the other day with the Fed chair, is that you still have the Board of Governors and the different Fed presidents in Chicago and Atlanta and all the other cities, and they vote on the interest rate cuts. And so it doesn't mean that the chairperson, in this case a chairman, isn't going to be the driving voice of it. But you still have to have a vote in order to lower interest rates. And so just a new Fed chair doesn't guarantee that interest rates are going to be lower. Now, again, they have overwhelming influence on the situation, and they are the voice, and technically they're the chairperson. However, there is a vote, and it doesn't mean that one person is singularly responsible for this. So while I agree with you, the president's nominating somebody who will lower rates, and it's different than having Powell there, there's no guarantee that rates are going to go lower in the second half of the year.
No, I mean, it's certainly no guarantee. And to your point, they're going to vote, and I believe they're going to continue to be data-driven as they have been. So, anything could change, and that's kind of the point. But we are seeing we're already seeing a divergence in the Fed governors, whereas they used to all vote in line for one decision. We're starting to see a split in that vote. And I think that the new Fed chair may be able to push that over the line, but we'll see what the economy looks like in 6 months.
And the most interesting thing to me is usually when you have, you lower rates, or you want to lower rates, it's because the stock market's slowing. Like it's a lever to pull to get the economy going well. If the stock market's at all-time highs, to lower rates seems to me that you're emptying the bullets in your gun, so to speak, before you need to. I mean, what happens if we get into if we lower rates, call it 3 more times between now and June or July, whenever the allotment is able to, the vote, and then all of a sudden unemployment spikes to 6 or 7, you don't have as much ammunition to help the economy. So I just don't get why on one side they say the market's doing great, and on another side they say, and lower rates so it can do better. I mean, it's growing at rates we haven't seen.
Oh, I very much agree with you. So in a typical recession, we see 2 to 2.5% rate cuts. That's the long-term historical average. And there was a time, I will say, in like that 2020 to 2022 period before we started raising rates, that it was a really serious concern that we had nowhere to go in terms of lowering rates, unless we joined the ranks of like the Germans who had negative interest rates. But we need to have that flexibility. What I will say is, typically when we think of the stock market, you made this point earlier, is typically when we think of the stock market, we think of the economy and we think of employment, and they're starting to be separated. So they may say the economy overall, or the economy that people are feeling in terms of employment, is starting to soften, or going towards a recession where we want to lower rates. That may be disconnected from the stock market at this point.
Yeah. Well, it's interesting. So when we get into taxes, right? And so with this administration, for sure, they're not going to raise taxes. But we have a situation where people may be taking gains. If the stock market goes up 1,000, and at the end of last year the market was good, and then now the market's at 49,000 plus, and people take gains. What's going on with taxes this year?
Yeah, so you're going to expect a couple of changes in taxes. We were supposed to see an increase in the tax rates, but now that we have the omnibus, or what they're calling the big beautiful bill, we have current rates in place for the long term. As people are starting to file this April, the thing that you're going to notice different is you may have a larger than normal tax refund for 2025. That may not be something you can expect in 2026. The reason why is when they change the tax code, they also update the withholding tables. So when your employer gives you a paycheck, how much should be withheld? They did not update those for 2025. So even though you owe less taxes, your employer may have, withheld more than they needed to for you. Not something you can necessarily expect going forward, but it's a good opportunity if you do have that to, do something smart with money, pay down debt, recognize, an opportunity where you have it. But also, on top of that, we have additional tax deductions. There's a over 65 senior tax deduction that exists now for people that are on tips, people that have overtime pay. It's a good opportunity to, take advantage of some of those savings and do something smart for your finances.
So let me ask you, there was a friend of mine, this is years ago, 25 years ago. He was in portfolio management, and a buddy of mine, another buddy, said to him, like, what's a great stock tip? Give me a stock tip. I want to make some money. And my buddy says to him, do you have any credit card debt? And he goes, yeah. He goes, how much do you have? He goes, $3,000. He goes, I can save you I can make you 18%. Pay it off. Do you think that argument, for people that are carrying credit card debt to pay off their credit card debt versus investing in the market, or what's your take on that dynamic?
Almost every time.
Pay it off,
with the exception of your 401k. If you have a match on your 401k, that's a 100% return right away. That's a strong argument to do that. But outside of that, there is not an investment that will reliably earn you as much as your credit card will cost you. If you're paying 18, sometimes 22%, there is nothing you can invest in that is going to reliably earn that over time. You're way better off paying off the credit card.
And it's such a great thing to note. And I hope everybody listening, for your own situation, if you have kids, if you have grandchildren, I talk to my kids' friends about this, like, don't accumulate credit card. Now, if you want to charge things every month and get the points and start to get free airline tickets, I get it. But make sure that you pay off your bill as soon as you can, because buying things you can't afford, the whole point is you can't afford it. Like, people forget that part. But if you can't afford it, maybe you shouldn't have it, right?
Totally agreed. You're referencing taxes. By the way, when you're investing the dollars, you have to pay taxes on that too.
Totally.
That's out earn not only the credit card interest, but the taxes. So I agree with you. If you can't afford it, I would seriously consider whether or not it's a need or something that's just going to be a weight around your ankles long term.
You know what? We're going to end it there. That is great advice from Phil Shaw at Goldstone Financial. And please check him out if you are interested in needing some help with your finances and investments. Goldstone Financial.